We can go.
So please, should we continue?
Oh yeah, sure. You can start.
Okay. So what if I'm going to the next slide? How would you know? Or
Oh
I'll tell you and you change it
yeah,
to the next one.
yeah. So next could be okay for me as a command.
Okay. Okay. Let's begin. Um, Good morning, everybody. So we are Team Prosper, and we are here to present on the types of insurance. Next slide, please. Next slide. Okay. So we can't talk about the types without knowing what exactly insurance is. So insurance is a financial arrangement that provides protection against potential future losses or risks. So risks, it's bound to happen. The best thing we can do is to protect ourselves against it. And these are some of the risks that we can face, which is health risks, liability risks, and accidents. Insurance here, therefore, is a safeguard. It's a way to safeguard yourself financially against unforeseen events that could have significant financial impacts on you. Next slide, please. Next slide, please. So here are the four types of insurance. First is the life insurance policies. The second is the accidents policy. The third is the fire insurance policy. And the last one, which is the marine insurance policy. Next slide, please. So the life assurance policy, one may ask, what is it? It is a type of insurance designed to provide financial protection to your beneficiaries in the event of death or at the end of a specific date. So this is to protect yourself. An example can be um, a husband and a wife. A husband and a wife. The husband can provide a life insurance for his wife or for his mom or for himself in case of a death, in case of the event of death, when he dies, like for example, if he dies, his wife and family will be able to gain some kind of some kind of financial protection from it.
Okay.
Do you get me? And there are three types. You have the whole life assurance, the term life assurance, and you have the universal assurance. So what is the whole life assurance? The whole life assurance is Yeah, the whole life assurance is a policy that covers you for your entire life as long as you keep paying the premiums. It usually has a cash value component that can go over time and can be borrowed against and cashed in. Let's move to the lifetime assurance. The lifetime assurance is a policy that provides a coverage for a specific period, and if you like 10 years, 20 years, or 30 years, and if you pass away during this term, your beneficiaries will receive payout, as I stated in my example. Yeah. If you outlive them, there is no payout. Like you get the trick here. And the last one, which is the life assurance. This is a flexible policy that combines life coverage with savings components. You can adjust the premiums and debt benefits as needed. Next slide, please. So this is an unforeseen event which can lead to death. And if you had the term life assurance, if you had a term life assurance and this happened to you before you outlived your time and you died, for an example. So your family will receive a payout of it, and they'll be able to cater for your burial, and some will be able like they'll be able to use them, they'll be able to gain financial like benefits, which will help them to be able to cover your funeral alongside, their personal expenses,
Okay.
since you are no more there to provide for them. Next slide, please. So what are the importance of the life assurance? First is to save for the future. As I said earlier, saving for the future. You do not know what will happen. You don't know when you will die. You don't know when your family will need money and all. So it's some form of like saving for the future. And the second one is to provide a lump sum for retirement. Yeah. Life insurance can also, during your retirement stages, you'll be provided some money regularly or on a regular basis, which can be able to help you with because in retirement, you are not working. So it will be in the form of a financial benefit to you. And the last one is financial reward in case of death or inability to work. Let's take in case of death, when you die, your family will gain some benefits to be able to cater for themselves and for your burial, because you are no more there to cater for them, and an inability to work. Let's say an unforeseen event like an accident, which can lead to like you know, or an unforeseen event like a disease like an illness like stroke, stroke will make you unable to work. So life insurance will cater for those days or in those years of your life where you are not able to work, and they'll be providing you with financial benefits. Yes, next slide, please. Next slide. Okay, so um my my sister Senna will continue for me from the stage. Thank you.
Okay. Thank you.
So I'll be taking the accident insurance as a type of insurance policy. So first of all, an accident is any unfortunate event or unexpected event, especially involving an injury or like damage to property or any sort of damage. So the accident insurance therefore covers all risks that happen unexpectedly and cause harm, hardship, or injuries to an individual. So moving on to the types of accident insurance. First, we have the motor vehicle insurance, which is this accident insurance policy is taken by a motor vehicle owner against liabilities he or she may suffer as a result of negligence or bad driving of someone else. Sometimes it could also be bad driving habits of the owner himself. So, in simple terms, it is an insurance taken to cover a vehicle owner and his vehicle. So, for under the motor vehicle insurance policy, there are types under that. So the first one is the third-party motor vehicle insurance policy. Here, the motor vehicle is insured against any damage it causes to another person or someone else's property. The third party will not be compensated if his car runs into a wall, but the owner of the wall will be compensated. It is required by law. So this insurance policy is a requirement by the law. The second type of motor vehicle insurance is the comprehensive motor vehicle insurance. This policy covers damage to other people's property, as well as the car owner itself or the car itself. The insurer will pay for losses incurred by the third party and also for the vehicle that has been insured. This will necessitate the payment for a higher premium because of the wide coverage, such as fire and theft of the vehicle. So this type of motor vehicle insurance is covering a wider range. So it is compensating the owner of the vehicle and then the third party. So the two parties involved. So it is compensating them both. So the premium will be larger since it covers a wider range. And then the premium is paid in bulk. So the second type of accident insurance is personal accident insurance. This policy covers a wide range of accidents, including cuts, injuries, all sorts of, damages to the individual on the farm, in the kitchen, at the workplace, like any type of injury that happen, whether you are working, you are going about your day-to-day life, or you're just, in your house, which may lead to disablement, loss of limbs, hospitalization, and even death. So the policyholder is paid a lump sum of money depending on the gravity of the injury. The third type of accident insurance is fidelity guarantee insurance. So this covers dishonesty of a worker to his employer. Employees whose duties involve handling cash can be covered against fraud and embezzlement. That where a fidelity bond or guarantee insurance is taken to cover the work of an employee and he embezzles it, the insurance policy will refund the money to the company and then later claim it from the employee. So this type of insurance policy is, like it's covering for in case like you employ somebody and then the person ends up embezzling the funds he or she was given. So it covers that aspect of business. The fourth one is burglary insurance. There are other types of accident insurance, but for today we're just going to be taking the four. And then I might mention a few, but then I'll not go in depth into them. So, and the burglary insurance, this covers theft due to forcibly and visible entry into a premises to steal. So this one, before the insurance will be covered, there must be evidence that the entry into the premises was forceful. So you can't, like, if someone, you left your door open, or like you were being careless and then the person just like walked in and took something, that I don't think the company will cover for that, because you were being careless, right? So the person, there must be evidence of forceful entry into the premises. So without evidence of forceful entry, the act will not be covered by the policy. The policy can be taken on private or business premises. Please, can we go to the next slide? Okay, so this is a vivid image of an accident. The other types of accidents insurance are aviation insurance, employers liability insurance, which I'll not go in depth about. So yeah, the importance of accident insurance. So financial protection. So accident insurance provides financial support in case of an accident that leads to injury or disability. The second is peace of mind. Knowing you have an accident insurance can give you peace of mind, especially if you engage in activities that carry a higher risk of accidents like sports or travel. The third is coverage for various scenarios. Accident insurance can cover for a wide range of incidents, whether they happen at home, work, or while traveling. This ensures that you are protected no matter where you are. Next slide, please. So the third type of insurance we're going to be looking at is the fire insurance. So this is an insurance against fire and its effects. And the policy covers losses incurred as a result of fire outbreak, which may destroy office buildings, factories, stock of goods, our homes, anywhere we find ourselves. So first policy does not cover injury, death of person arising from fire outbreak. The fire must be an accidental one. It means it must not be like an intentional something. It mustn't be deliberate, which is caused by the insured before compensation is paid. So if it was not, if it was a deliberate fire outbreak, the company will not compensate for that. The following are the examples of fire insurance. So the first one is fire insurance on domestic and business premises and their contents. This one, I think it speaks for itself, so I don't have to go in depth. The second is the consequential loss insurance. Indirect loss, which accompanies an insured loss, such as loss of earnings resulting from a burns down business that was insured against fire or loss. Consequential losses are not usually covered by ordinary insurance companies unless specifically included on payment of additional premiums. The third type of fire insurance is the special peril. So it's supposed to be perils. I'm sorry, like if you didn't see that. It's PERILS. So special perils, example, flooding, earthquakes, burst pipe, tornadoes, etc., which can be covered by an additional premium. So the special perils are talking about those special situations that occur, like natural disasters and the rest. Yeah. So the last fire insurance is, thank you for correcting me. The last fire insurance is example of fire insurance is household policies. So household policies covering items like our television sets, our fridges, our microwaves, our blenders, and etc. Thank you. Yeah, so this is an image of a fire out.
Okay, so I'll be taking the last type of insurance that we'll be discussing. That is marine insurance or the marine insurance policies. So this is an insurance policy taken to cover or offer protection against the movement of goods and people in vessels on the sea and other water bodies. So it covers the losses of the vessels, the goods on board the vessels, and other injuries or death that may be caused by the marine risk. And there are several policies under this insurance. The first one is the hull insurance. So this is when policies are taken to cover the any damage to the vessel. So if any part of the ship undergoes any kind of destruction, if the ship owner undertakes the hull insurance, the marine insurance will cover for the loss of that part of the ship. So if maybe the anchor of the ship gets damaged, as long as you are under the marine insurance, you'll be compensated. And then we have the cargo insurance. So this insurance is taken to cover losses to goods that are being transported on the ship. Sorry. So if there's loss, maybe the ship sank and the goods also sank, or if there's any kind of theft, or property damage, the insurance will cover for the loss of the goods. Then the freight policy. So this is a marine policy taken to cover the cost of carriage that may be lost by the ship owner or the carrier for the inability to deliver goods to the agreed destination. So if for some reason, maybe because of the ship sinking, you are not able to deliver the goods, the ship owner, let's say you are delivering goods for someone. If you are not able to deliver the goods, obviously you will not get paid because you weren't able to do what you were sent to do. But then if you are under the freight policy, you'll be compensated for trying to get the goods there. And if maybe you were paid before the delivery, and then the owner of the goods asks you to refund his or her money, the freight policy will compensate you for that refund as well. And then ship owner's liability. So when you are the owner of a ship transporting goods, you are liable to a lot of distraction or a lot of damages, like maybe, sorry, one. Okay, sorry. So, the ship owner's liability, like I was saying, the ship owner is liable to a lot of things on the ship as long as he owns it. Like any injury to any of the workers, or any cargo damage, or any environmental pollution that the ship may cause, like water pollution from maybe oil leakage or something. So, on a normal note, the ship owner will have to pay for any of those situations if they occur. But then if you're under the ship owner's liability policy, the insurance company will cover for those losses. Okay. Next slide, please. Please go back a slide. Okay, I think there was some parts that was missing, but then the policies under the marine insurance, they can be classified into some other policies. The hull insurance, cargo insurance, freight policy, and then the ship owner's liability and other policies can generally be classified into time and voyage policy, valued and unvalued marine policy, floating or open policy, and then fixed policy. So the time and voyage policy is like when you undertake a policy to be insured against any loss, you put a specific time frame on it. So if maybe if a loss was to occur within, let's say you insured for 2 months, if the loss was to occur within the 2 months, you are fit for the insurance. But then if after 2 months the loss occurred, you can't hold the insurance company is not compelled to compensate you for that loss because you put a specific time frame on it. And then the voyage is a destination frame, like maybe so you give them some miles or kilometers, I don't know, some kind of distance that after that specific distance, anything that happens to the cargo or to the ship is not liable under the insurance company. Then you have the value and unvalued marine policy. So when a marine policy is valued, it means there's an agreed amount to be paid to the insured in case the risk insured against occurs. So there's the insured and the insurer agree on the value of the vessel or the cargo before the policy is issued. So the policy will specify a fixed value for the vessel, which is to determine the amount of coverage. And in the event of any loss, the insurer will pay the agreed value without requiring any proof of the actual value. And then for the unvalued policy, the insured and the insurer do not agree on a specific value for the vessel or cargo. So the value is determined when the risk occurs, not before the risk occurs. Then the floating or open policy, it's like you pay the premium beforehand, it's prepaid, and it's to cover a long-term shipments. Like maybe if you are shipping grains, corn, let's say corn, you constantly ship corn monthly. You pay the premium at the beginning of the year to cover all the shipments instead of paying every single time you are going to ship goods over the sea. But then then there's the fixed policy. The fixed policy is a marine insurance in which the same premium is paid for each voyage made. So this one you don't pay beforehand for the entire shipment. You pay each time you are shipping out. Please, the next slide. Okay, so that ends our presentation for the types of insurance companies. So we have the marine accident. Sorry, for the types of insurance, we have the marine, the accident, fire assurance, and life assurance. And they are all essential types of insurance that can provide the beneficiary with the needed financial protection against unforeseen events. So as a business owner, you have to know and understand the features of all the types of insurance so you can make informed decisions on the right policy to undertake to safeguard your business or your personal assets. Thank you.
Okay, thank you very much, my able professors. That was an awesome and a swift one. Wow, I must say I'm highly impressed. And but I have few questions to ask, few point clarifications. So I guess we'll do that in the next session. Professor Chan, if you also have any issues, you bring them on board as well when we. However, if the team members also want to seek clarification on certain things, they can also do so. So let's meet in the next session. But that was awesome. I'm highly impressed with the fluency and the manner in which you did the presentation. So I'll see you in the next session.